Another popular cash flowing assets are dividend yielding stocks. Dividend growth investors often disregard safe withdrawal rates because they believe they can live off dividends. Do you think that dividend yields can ever be a replacement for safe withdrawal rates?
No, and I've had lengthy discussions about this approach, and I think it's a very foolish approach. And so, first of all, let's distinguish between two separate flavors in this whole community. Right? Let's look at just the dividend style, and then dividend style plus stock picking within that style. All right. So if we just look at the style picking first, right? Do dividend stocks add anything to your safe withdrawal mechanics? So imagine we shift away from the broad market, right? S&P 500 index. We can also shift to something that is still relatively passive, but is doing dividend stocks. Right? I mean, for example, Vanguard has a fund, VYM, Victor Yankee, M as in, what is it? Marketplace. I'm just making that up. So VYM. And how did that fund perform recently? And so we have returns going back all the way to pre-global financial crisis. And turns out that VYM ETF actually even slightly underperformed the S&P 500. And again, this is both the S&P and that VYM fund. I consider the total returns, right? Price return plus dividend yield. And so it didn't really do anything in 2008 and 9. It actually detracted just very marginally from your performance. And then most recently in 2020, that fund vastly underperformed the S&P 500. So it didn't help you in that market crash either. So it doesn't look like that just shifting to a dividend style is going to vastly help you in terms of your safe withdrawal rate. And so, of course, this dividend focus you're a little bit lying to yourself, because obviously dividends, they can be cut. They can stagnate, right? They can stagnate so that if you want to withdraw just the dividends, then, well, your withdrawals might not even keep up with inflation. So a dividend is not any kind of contractual agreement, right? So the companies can, and they have cut their dividends, right? And so, of course, the dividend crowd is going to say, oh, no, I mean, because you're doing it wrong, right? You can't do just the passive index fund, right? Because what Vanguard is doing is, this is not an active strategy. So what Vanguard is doing is, instead of doing a market cap weighting, just like the S&P 500 index funds or the total stock market funds, they weight the stocks by how much they pay in dividends, which is still relatively passive, because the weights are not going to change all that much. But there's a little bit of trading involved in managing that. So what the dividend crowd is now going to say, wow, you can't go with this passive fund. You have to pick the good dividend stocks and the stable dividend payers. And then there are all sorts of dividend aristocrats and dividend princes and dividend kings and there's all sorts of additional ways of screening stocks in this dividend universe, right? Where because you can't just go with stocks that pay a high dividend. You have to go with stocks that have been paying consistent dividends, have been raising their dividends every year. But then again, now we are wading into stock picking, right? And if you remember your discussion with Rick Ferry, you're not going to beat the market that way, right? I mean, just be serious. Especially considering that, look, I mean, you are up against other active professional investors that are stock pickers, that are looking for where are cheap stocks that we want to invest in that will go up more than everybody else. And so it's not like by looking at just dividends, you suddenly have the secret sauce for becoming an active investor. Right? I mean, think about it, it's almost laughable to believe that you are the only ones looking at dividend and dividend yields and dividend consistency and dividend growth rates. That's all being looked at by all of the all of the active investors all over the world. I mean, you're not the only one looking at this. And the prospect of you finding better returns through dividend stock picking, and I mean total returns, right? Dividend plus price return. The prospects of that happening are pretty slim to none. And I just want to give you one example, right? If you look at some of these dividend aristocrats, you can obviously look at what the dividend aristocrats are today, and you will notice, these are all stocks that have performed really very well over the last number of years. Now, the problem is there's a survivorship bias, right? I mean, what about all the dividend kings and dividend aristocrats that somebody might have held along the way that then dropped out of the dividend aristocrat crowd, right? I mean, what happened to them? Well, what happens to a stock that was considered a dividend aristocrat and then stops paying a dividend altogether or cuts their dividend by 50%? I mean, they're going to get clobbered, right? I mean, first of all, you have a lower dividend. And then what do? Do you sell the stock at that time? Do you hold on to it now that it's paying a lower dividend? I mean, this is really a damned if you do, damned if you don't, right? To pick your poison. And I look back at who were the dividend aristocrats back in 2007. And yeah, I mean, a lot of dividend aristocrats were banks, as financial companies, because they were considered very solid dividend payers, very solid business models, very profitable. Yeah, and then they got clobbered during the global financial crisis, right? The Bank of America, I don't think they ever completely eliminated their dividend, but I think they went down. The dividend went from 18 cents a quarter to 1 cent a quarter, and they stayed there for a very, very extended period. And so the stock price was down, the dividend was down. And so again, I mean, what may look like a very solid dividend payer today might become the worst stock, that might become your worst nightmare. I think GE used to be, as General Electric used to be, a very stable dividend payer, and I think then they had to cut their dividend at some point, and they also got clobbered really badly. So think about it. I personally don't think that dividend tilt, neither on the index level nor by stock picking, is really going to add anything. In fact, in 2008-9, it even subtracted a little bit from your performance. It vastly subtracted from your performance in 2020. So I was never a fan of it, and I'm not saying that dividends are bad. I'm just not saying that they are better than the index. And I wouldn't short dividend stocks. Right? I'm not saying that they are bad. I'm just saying that they are not better. And so in that sense, I mean, I wrote extensively on this issue. I mean, I wrote 3 blog posts, the Safe Withdrawal Rate series, parts 29, 30, and 31, where I debunk some of these arguments on, can't we just increase the yield of our ETF portfolio and then not have to worry about sequence of return risk? And that kind of strategy would have catastrophically backfired in 2008-9. And the nice thing is, I wrote this before the 2020 episode. And then I was almost afraid that, hey, I now bash all of these dividend strategies, and then the next recession or the next bear market comes around, and then they do better. I would have looked a little bit bad. It's not like I would have been wrong, but because I never said this dividend yield and pumping up your yield is bad for you. I'm just saying it's not better for you, right? I wouldn't bet against that either. But I was actually feeling really nice that even in 2020, again, this pumping up your yield strategy was not doing very well in that bear market. So we now have already 2 bear markets back to back where this dividend strategy didn't do very well. So that's why I'm not a fan of it. And my line of reasoning is probably very similar to what Rick Ferry would say, but again, my personal little flavor. But probably 90% is the same philosophy as Rick Ferry.
Yeah, I have also written an article why dividends are not passive income, and all dividend lovers have said that I'm a hater, and why don't I think there may be different strategies and all of them can work? Not my strategy, but also theirs. So somehow they really believed in this idea of yield shield, let's say, from dividends.
Right. So again, so that yield shield is what I specifically try to debunk in those 3 blog posts. But again, I mean, people are obviously very emotional about this. They dedicate a lot of time, and then people like us, we trample on all of their beliefs. So it's again, I mean, I don't want to bash them, right? I'm not saying that what they're doing is worse, right? I personally believe that dividends versus capital gains, I mean, it's both money. I like both, and what matters for total returns is basically the capital asset pricing model, right? If your stock has a higher beta or a lower beta, that has a higher expected return. So if you give me 2 stocks, one with a high dividend yield, one with a low dividend yield, they have the same beta, and then potentially some of the same other pharma French factor exposures, my personal forecast for expected returns would be that they both have the exact same expected return, even though one has a dividend of 5% and the other one has a dividend of 0%. So I would say that's what matters. Cap M plus some adjustments matters. The dividend yield itself is probably irrelevant.
And also, if you think about efficient markets, all assets should have the same risk-adjusted returns. The problem with individual stocks is that also they have idiosyncratic risks, and not only systemic risks. So if you want to, let's say, take more risk, at least do it in a diversified way, like an ETF or something.
Right. And then I would almost be afraid that some of that idiosyncratic risk might then also be correlated among all the different dividend stocks that you have in your portfolio, right? I mean, this would be risk that is not yet captured by some of the major factors like the market and then small cap value and the like. So you might actually have a lot of stocks with a lot of idiosyncratic risk, and on top of that, they might also have potentially some correlation among their idiosyncratic, because the stocks that you might pick up that might have some other hidden factor that people haven't thrown yet into their factor model yet. So yeah, I mean, there's a ton of philosophical, economic, financial, statistical reasons not to get too excited about this dividend yield stuff.